Hi guys, welcome to my channel. Today is going to be question answers type of video. How long does a divorce last? And this question comes up almost every time, and I figured out a formula. A divorce lasts approximately 9 months. And the reason how I figured this out is from the date of filing until divorce is final, depending on the complexity of the case, I noticed that out of 100 cases, some cases get settled in 4, 5, 6 months, rarely, but most cases are settling about benchmark 9 months, 1 year. And it requires both parties to cooperate. So if one party wants a divorce, they still can file a default if the other side is not cooperating. But the best case scenario, if both cooperating, hiring neutral accountant or develop a strategy how to settle with a mediator, if the asset split is simple, and that's it. So second question I get asked, how to create that split? Well, as you know, we have date of marriage, date of separation. This is the time frame when community property is accumulated through personal work, through personal effort. Usually it's work. So for example, someone gets W-2 and bonus, and then whatever is spent is spent, whatever is saved is divided equally. And anything brought into the marriage before is separate property, meaning is not subject to a division. So for example, if someone has a house that it's valued at $500,000, well, that's their separate property. And if they add a spouse to the title at the time when they get married, then the spouse gets the increase in value up until the divorce. Now, let's talk about at what point do we split assets? And it depends on the type of asset. So simply explained, if we have a checking account that has $100,000 at the date of separation, and parties are taking money out of this and spend it on personal expenses, on community expenses, then I suggest we split it at the date of separation. Because by the time if we split it at the time of trial, it might be $0. And then we have to do post-separation accounting, which is a nightmare. Basically, we look at what has been at the date of separation, then at the date of trial, and see who spent how much on what, and reverse it, credit that person extra money, basically. If, for example, one spouse took $100,000, then the community gets credit back $100,000 if that spouse spent it on his or her separate property. But if they spend on community, then I wouldn't suggest doing that. So I suggest to split it at the date of separation. If you need to use the money, then I suggest to split the money at the time when it's date of separation, to say, okay, you keep $50,000, I keep $50,000, and we agree to spend our money the way we want it, so that we don't have to do post-separation accounting. And ideally to use the money for personal expenses, not for community, so that there is no reimbursement claim later. What about real estate? We evaluate real estate at the time of trial, not date of separation, because real estate market is going up and down, and at the date of separation, it could be 2 years earlier, and if it's rental income or one spouse occupies this, it doesn't matter. We split it at the time of trial, or we agree on the date that the evaluation is going to be used for the purposes of splitting, so it doesn't change all the time. Now, what about investment account and retirement account? Both of them are similar in the idea of looking at it as date of marriage, what was accumulated, how much was at the date of marriage, how much was at the date of separation, plus interest at the time of trial. So for example, if at the date of separation there was $100,000 and someone put after date of separation, another $100,000. Then we calculate $100,000 increase in value at the date of trial and exclude the other $100,000 in increase in trial. It's called timeline rule. And what we usually do, we create a qualified domestic relations order that allows to roll over if there's a difference in accounts. For example, in one spouse's account it's $10,000, another spouse's account it's $100,000, then the one who has 100 needs to roll over the difference to equalize the payment. And because it creates tax consequence, a tax liquidating event, and it would be penalized otherwise if you withdraw retirement money before the liquidating event, retirement, then Quadro prevents that from happening, qualified domestic relation order. So, investment account, same thing. We use the date of separation to see if nobody put money into investment account and just goes, stocks are going up and down and we don't need to exclude any money, then we evaluate investment account at the date of trial or the closest date to trial and exclude any money that was put in to that investment account. All right, I think that's all for today. I hope you enjoyed it.